whenever you get into a trade, like rule number one is to think about the downside first. How much do I lose when this goes wrong? Everybody does the opposite. They go like, oh, wow, how much money am I going to make when I get into this? And it does like 100x or whatever. And they do all their sizing and all their fantasizing about the outcome on the bullish side. And they don't start thinking about the downside until things start moving against them. And that's precisely the wrong time to do that. So whenever you guys get into a trade, rule number one is to figure out, where am I wrong on the trade? Where am I getting out of the trade? And how much do I lose when that happens, right? Your liquidation price is not your risk management. I think a lot of people think that like, oh, you just go levered long, and if you get liquidated, that's it. That's just it. That's not how it works, guys. Like, people aren't sitting there with $10 million accounts and then they're just like, oh shit, I got liquidated. Damn. Guess I'll open a new $10 million account. Doesn't work that way. So that's my intro to the discussion. I want to kick it over to you. I know that you do your own kind of version of risk management. It's a little different than what I do because you are working with a little bit different instruments to me. But curious your take, how you think about this, like what you do that works for you. What are some nuggets that other people can kind of take into their own trading?
Yeah, I think it's very context dependent. You kind of just alluded to that. I think there's like, let's just talk about one archetype. There's like long-term holders who just buy the index, right? Like, I don't think you really need to risk manage that. You're just like holding that forever.
Mm-hmm.
I feel like that's fine to not even really risk manage.
Yep. More investing.
Yeah.
The more investing, the less trading. I think it's a useful heuristic is that you don't need as much risk management.
Yeah.
There's still some risk management in investing.
Yeah. Like even the example that I shared earlier in this pod, like buying Amazon and Google when it's 20% down, like, am I really going to like set a stop loss on that? No, probably not. Like I'm just investing in those. I do it more when I'm trading options. And the way that I go about it is probably a little different than how you risk manage on perps or in coins or something. And the way that I typically do it is like I plan my exit in advance on the upside. So if I'm buying a call, I'm selling an out of the money call on top of that. And that can really fund like so much of the call, the long leg, that it ends up protecting you. Like on MicroStrategy, for instance, there was a time where I was long MicroStrategy calls, but I sold MicroStrategy calls out of the money. And I was wrong on that trade. But the short leg protected 80% of the downside. And I just put those on at the same exact time. And I just set the out of the money call at the level that I was like picturing MicroStrategy to go. And, you know, of course I was wrong. It went down, it didn't go up, but I only lost 20% on the trade, which is in options land. That's like pretty good risk mitigation.
Mm-hmm. Now you do some of the most dangerous stuff that exists out there because you do some like just naked put selling, right?
Well, I do naked call selling too, so that's even more dangerous.
That's true because the unlimited,
yeah. Right?
Unlimited to the upside. Okay, so I mean, let's talk about that because that to me is like the most dangerous thing I could think of. Right? You're basically exposed to infinity in the other direction.
Well, let's talk about
how do you approach
let's talk about naked put selling first because I think this one is like
probably easier, yeah, because you know where it can go.
And I don't think like people are going to be selling naked calls, you know, so I don't think we need to really even talk about it. But if you're selling naked puts, I view it as like your downside is the stock goes to zero. Mm-hmm. And that's the same downside you get if you're just like holding the common stock. But I'm typically selling out of the money. So my risk is actually lower. It's actually safer than just buying common stock. The only time where it isn't safer is when you oversize, you like overexpose yourself on the number of contracts.
Yeah, I was going to say like that could definitely be a lot riskier because you're maybe selling 10,000 times the size of what you could buy.
Yeah, and
just with the common stock.
In our Naked and Afraid channel, poor Shrank just went through a liquidation event as he was selling puts, and price was going down. So he got margin called. But this is something I've been through too. Like, you just learn the hard way to size properly, because when you're doing this game, the sizing is what really gets you. And, like the way that I do it, it's like just slowly accruing your wins and stacking up those wins over a long period of time, which ends up being a nice yield. But it doesn't feel like a lot of money on a weekly basis. If I'm making like $100 on a name in a week, people are like, well, why the fuck am I doing that? But then you just do it, like, you just do it over and over and over again, and it just stacks up and it compounds. And, like that strategy can return 30% on an annual basis. So that's the way I do it.
30% is a good return. That's nice. That's nice. But selling premium is so seductive and dangerous to people, because it's like the opposite of how humans are. We have like loss aversion, right? We feel an equivalent loss as being like twice as bad as a win, or more than that for some people, right? So in the other direction, like, we get biased to feeling really good about getting like frequent, predictable, like low hits of dopamine, which is what you get when you sell deep out of the money premium, right? You're like almost always winning, and it's just like money coming in, money coming in, money coming in, money coming in. And then the downside is like out at the tails. And like humans, in addition to being sort of like asymmetric in how they feel loss versus gain, are also very, very bad at evaluating non-linear outcomes, right?
You're very right about that.
So the tail risk of options is very non-linear. It's just like this like kind of fat tail thing way out there on the bell curve. And we have a very difficult time like conceptualizing what that means, what that means, like to have like a 1 in 1,000 outcome happen or something. But actually, if we do this for 10 years, like it probably will happen. And then we will blow up our entire portfolio. It's like very difficult for people to.
Well, I'll tell you how
through.
that, like, that phenomenon that you're describing is very real, and how it manifests itself in practice is that you typically see like greed take over when you're like, because I win 97% of contracts. That's like my historic level. Like, there's a little voice inside you that's like, do more, do more, do more. And you kind of have to just like learn. I've learned through experience to not do more, and just like take your little wins, stack up your wins. And like, when a loss does happen, you don't just get steamrolled.
Do you think like the vast majority of people should just like only be selling like spreads, so that there's like or is there just not enough money?
No, I've thought about this a lot, because like I haven't launched the product, but I was thinking about launching the product, and I would like, the analogy I was making in my mind was like, when you watch like a workout video, like an exercise video, they have like the exercise, and then there's like modifications, for people who are like, don't want to do that much. They're like, okay, so here's the modification. You just do this instead. I feel like the spread that you're describing is like a very simple modification for people who have like a lower risk tolerance. It still makes money. It's less money. I mean, you can juice it up higher, is one way to do that, because you like limit your downside with the spread.
Yeah, the spread is nice because your downside is fixed and knowable, right? So you could be like, okay, well, and sometimes it's sobering, because you're like, wait a minute, if this goes wrong, I'm blowing up $20,000 and I'm making $200.
Yeah, exactly.
Right?
Exactly. So. I don't like the spread typically, because like my way of mitigating risk is not like through capping it with like a spread. It's mitigating it through size, and like knowing that I can be long the name. Like, if I actually lose this thing, like I'm selling puts on things I like. Like, if I sell a put on Amazon that's 50% down, I'm like, okay, that's my downside, is I have to buy this thing, fine. But like, I size it to a level where I'm like, okay, buying that. But if you're like, I get what you're saying. Like, of course, for somebody who doesn't want to buy Amazon, then putting the spread on is a way.
Yeah, I mean, you've got like the cash in the account, and you're just gonna buy it if it goes to that level. So no harm, no foul. But people oversize. They don't have the cash.
I swear, oversizing is the name of the game, because like, here's another thing that happens. Like, if you've sized it correctly, you don't even need to take the shares, right? If Amazon, I'm selling 50% down, like let's imagine some like 5 standard deviation move where Amazon actually goes 51% down, and I start losing. Like I would actually be okay just closing that trade out for a loss, and you only lose the 1%. That the delta beyond your strike is like all that you're losing. So like when I'm selling way out of the money, even when I lose, I typically don't lose by much. But again, where it fucks you is if you've oversized it, then like you're just getting hammered. You're getting hammered by that, and you might be forced to liquidate even before maturity if you've way oversized it.
Yeah, and as somebody who like trades leveraged derivatives for a living, I will say that virtually everybody listening to this podcast should not do what Eric is doing. We like to explore risky stuff on here. It's just kind of what we do.